Bitcoin getting crushed again. It is now off 16% since hitting all-time highs earlier this month.
But the bank also pointed to tens of billions of pounds in extra savings by households who have not been able to spend, but at some point could be unleashed. Another much-needed shot in the arm.
Assalamu alaikum, and welcome to another program on Focus on Finance. In today's program, we take a closer look at shares and the stock market. Joining me in the studio, Niazi Hoolash, an accountant by profession, and Shamin Sookia, a managing director of a corporate finance advisory firm based in Mauritius and former head of listing at the stock market in Mauritius again. Assalamu alaikum.
Wa alaikum salam.
So today we're talking about stock markets and shares. In a previous program on investment, we briefly touched on what a share is. Shamin, if we go back to that and let's go into a bit more detail of what a share is and how the stock market fits in terms of shares.
Thank you very much, Shafique. So a stock market, as many people would tend to think, so it's like any market. If you can compare it to like a market where you have mangoes, you have fruits which are being sold. So instead of having fruits or mangoes or cars, so you have shares of companies who have voluntarily come to the stock exchange to place their shares for secondary trading on the stock exchange. What does this mean? Is that when the company comes for a listing, it lists on the stock exchange, so it's voluntary. The directors have given their approval for the company to list its shares. So let's say the company has, let's for simplicity, right? For simplicity's sake, so let's say company has 100 shares. So all the shares are floated, so that's the technical word that they use, on the stock market. What does this mean? Is that the company's shares are listed or quoted on the stock exchange. So all the shares are deemed to be listed, to be quoted on the stock exchange, ready for trading between existing buyers and willing and existing sellers also. So the stock market is like an ecosystem where you have companies, like I said, who have brought their shares onto the market for the owners, the shareholders, to sell those shares to people who want to buy those shares at a particular price, which normally is determined by the forces of demand and supply.
So it's a marketplace. So a stock market is where people or companies can go to buy shares. But let's take a step back. Let's remind people what shares actually are. What is a share in a company?
Well, as the name suggests, Shafique, thank you. A share in a company actually means that it's a share in a company. So, for instance, let's say a sole trader owns a business. Let's say I got a business. It's a car dealership. So I might value my business at $100,000 because I invested $100,000 in it. So now, I'll be owning 100% of the company, which is worth $100,000. And let us say that instead of just only me, there were maybe 5 people who are equally sharing or equally owning the company, then each one of us would have had 20%. So my shareholding would have been a shareholding of 20%. So what typically happens is that a share is it's a title deed which entitles the holder to a part of the business. So let us say a company decides that it will split its ownership into 100 equal parts. It will mean that you've got 100 normally ordinary shares, all right? And there can be a person can own 1 or more shares, and depending on the amount of shares a person owns, it will assign to that person a proportional degree of ownership, of control over the company. And generally speaking, if someone owns 51% or more than 50%, they're generally considered in simple terms as having a controlling interest in the company. Although it's not always the case, but that's a simple rule.
Yeah, so in simple terms. So what we hear the term shareholder. Well, what is a shareholder then?
So taking on from what Niazi said, so a shareholder would be the owner of a particular share or a number of shares in the company.
Okay.
So that particular shareholder would own shares with all the rights attached to those shares. We will not get into that detail now. So with respect to earning dividends, voting rights. Some shares have voting rights, but some shares also do not have voting rights. So we also have different types of shares. So we can talk about that later.
Okay. But in simple terms, shareholders are the owner of these companies, which are, as you say, listed in the technical term. Perhaps it's useful to take a step back and contrast companies with listed shares with other types of companies and other types of ownership of companies. It's share ownership or share issuing companies are not the only types of companies out there. I can think of partnerships. How would a partnership differ from a company that issues shares?
Well, actually, it is more of a legal form. Okay? Each partner have their share in the capital of the partnership. And now today we've got things like limited liability partnerships, which are very similar to companies to a large extent.
But perhaps let's go back and define what is a partnership and contrast it with a share owner.
Okay, very simple. Okay, let's take the same business, the car dealership. 5 people in there who are equal partners. It means that they all have a percentage of the business. There's not like legal titles, like a document which says this is 1 share, 2 shares, 3 shares, each one has their thing. But it's just, all right, based on the capital that they've introduced in the company, this will be their proportional share in the partnership. And one of the key difference, when we talk of shares, it's shares in a company. The company itself is a legal person in itself. And when we talk about limited companies, which is the most common type of company, so the shareholder and the company are 2 different legal entities. Whereas in a partnership, you can refer to a partnership, but the real responsible person legally are the individual partners. So that would be probably the single main difference between a partnership and a company. This is in terms of the legal personality, which is distinct for the company, but which are the individual partners for a partnership.
Yeah. So a partner would be typically professional companies, so lawyers, doctors in a practice would have a share of the company without actually issuing shares. Shares are what you would sell to other people if it's listed. Is that correct?
Yeah, you're quite correct. And as you pointed out, so apart from shares of listed companies, so as you said, companies have separate legal entities with regards to, as opposed to their owners, right? So they are legally separate as opposed to a partnership, for instance. But on the stock exchange, what we've seen up to now, so a partnership, for instance, would not be allowed to list on the stock exchange. So you would have companies who would come to list their shares. But apart from listed shares, so you have many other instruments that are listed on the stock exchange. As one would know, so we're speaking about finance today, so there are 2 types of funding, which normally a company or even a person, let's say you take a sole trader who wants to open a small car dealership, as taking on the example from Niazi. So either the owner would put in his own money or her own money, or they would borrow to put that funds into the business to grow the business, of course. So on the stock exchange, apart from the fact that you have ordinary shares and other types of shares which are listed, which is called equity capital, so it's the capital of the company or the owners, you have also debt capital. And this is very common today. We've seen a lot of those, like we've heard about corporate debts, corporate bonds. They have the sort of same similarity in terms of their characteristics with regards to shares as opposed to shares. So you would have, like, let's say you have a debt issuance or bond issuance or notes issuance. So there would be this sort of proportionality of the totality of the funds, of the debt funds that are being listed. So let's say you would have like 100 notes which are listed. So normally a company, apart from the fact that it would take on so equity capital, so investing their own capital, their shareholders, so they can take money in the form of debt. And those particular debt instruments also listed on stock exchange. We have a lot listed around the world today, very sophisticated instruments, which I will not enter into that debate today. Some are halal, some are not halal. So better stay away from, of course, non-halal.
Yeah. So the shares would be when the companies are selling a portion of the ownership of the company, And a debt is where, a debt instrument, as you say, is where they are getting a loan from the public. This is the way they're getting, rather than going to a bank, they are asking people to invest, to lend them money, in fact, but they're giving them a piece of paper, which is what is called the debt instrument. Is that, do I understand?
Sure, I think you put your finger right on what is a debt instrument. So in a sense, so there's debt capital and there's also equity capital.
Right. Okay. And as you say, some is halal. I think the halal versus haram comes down to interests. So shares do not pay interest, is that correct?
Well, do shares have an element of interest? It depends. If you have ordinary shares, which confer upon the holder, the shareholder, an ownership into the business, normally your return on it will be in the form of dividend, and that is fine. There's no interest in it. Unless you're holding interest in the bank.
But let's define what a dividend is. Maybe our viewers may not understand what is a dividend.
Yeah. A dividend is in fact the share of the profit of the company which is being distributed. So for instance, a company might make $100 profit, and the directors might decide that they're going to distribute maybe just $50 of it. So that $50 becomes the dividend. And each shareholder would earn their share of that dividend in proportion to their shareholding.
Okay. So it's the income that the share generates for the holder of the...
Correct, when it is an ordinary share. However, they are what we call preference shares, shares which have the characteristics of debt, very similar to debt. And typically you have these types of shares where, as the name suggests, they are in preference over ordinary shares. So often what we find is that the remuneration of those shares is in the form of a fixed rate, a fixed percentage, based on the face value of that share. Now it will be very similar to interest. Although we do find different mechanisms being used to make that instrument a bit more like equity. But long story short, it depends. In certain cases, there may be shares which earn interest.
Okay. And as you said, so these are things that are traded on the stock market. But to what extent does the company benefit from the shares being listed on a stock exchange? Because once it's only when they initially list their shares or offer their shares to the public does the company get the money for selling the shares. After that, they are selling between parties which are not sending any money to the company. So in what way does this help the company to have its shares listed?
Sure. So when a company would come to the stock exchange, of course, so when they will do IPOs, for instance, so they would raise initial capital. They already have capital, but they will raise additional capital. So this is called the primary market, in the sense that there's issuance of shares, right, against shareholders, new shareholders, putting in their money in the company. And then when the company is listed, so it would have complied with all the requirements of a stock exchange with regards to certain documentation to be provided. It's quite very strict, in very strict circumstances. So then there will be, like you said, so secondary trading. There will be the shares of the company would be floated and would be available for sale to existing buyers, and also you have willing sellers willing to sell their shares at a certain price, which is dictated by the laws of demand and supply, the forces of demand and supply. So what about the company? Does the company benefit from a flotation of its shares? There are certain benefits associated with listing company on the stock exchange. For instance, the owners of the company, sometimes when they would like to grow to a certain size, so they would invite the public or even private places, so people who would come in like big shareholders, and those shareholders, those particular shareholders like the pension funds, for instance, they would be keen to invest. They would be likely to invest in a company which is floated in an IPO, provided that company is listed and abides and complies with all the requirements of a stock exchange. Because what are the requirements of a stock exchange? So when the company is listed, the company's shares, when they are floated, so the company has to comply with certain strict procedures of disclosure. The company has to be transparent with regards to its publication of accounts and material information about the company. So, because the platform of the stock exchange is a market, as you said at the beginning, where there are buyers and sellers coming in, and where there is price discovery. So they discover price, they discover the company also, and then we buy on the basis of information that is relayed to the market in a transparent manner to everybody. So this is one of the advantages of bringing a company to the stock exchange. So the owners, sometimes the existing owners, they would invite other people to bring in money to increase the capital of the company for them to develop, to grow, to enhance the development of the company.
Thank you, Shamin. So we've heard of some of the advantages from the company's perspective to be listed. Any other advantages for the economy as a whole?
Yes, definitely there are more advantages. If you look at from the angle of the investing public, the fact that a company is listed compared to a company which is unquoted, a company which is listed has to comply with very strict rules, as Shamin was just mentioning. And this provides a form of confidence, safety, and trust from the investing public that when they are putting their money in a company which is listed, it means that there is a regulator which is ensuring that those companies and the management of the companies are doing things by the book in a transparent manner. And that scrutiny means that the investing public at large, and often institutional investors who are dealing with the money of the society at large, like pension funds, they have that trust that investing in a company which is listed provides a relative safety for the investor's money. So that would be the
So definitely, I think the pro-investment, the pro-capitalist viewpoint of stock markets are very good. But there isn't an alternative view as well. We have moments in history and economic theorists that say, well, the stock market is not rational, it's not perfect, and they point to the stock market crashes. So we've had the ones in the 1920s in the Western world, where leading to the Great Depression, or just before the Great Depression. We have every 10 years or so, I think, there are stock market crashes. And for viewers, what a stock market crash is, if I put it simply, today the stock market as a whole puts a value on all the companies of, let's say, 100. And there are certain measures of this which are called indices. So the FTSE 100, the Dow Jones Industrial Average. These are just a way of summarizing the value of a stock market. A stock market crash is when today it's worth 100, tomorrow it's worth 50. And people say, well, how can a company that's still making Coca-Cola, still making cars, still making pharmacies, overnight be worth half as much as the previous day? How does that fit in with the advantages that you put out? Crashes do happen.
Yeah, definitely. And we have to understand, I agree with you, we have to understand what causes the crashes. So often, the crashes could be as a result, it is first clearly based on speculation. Maybe an asset was overvalued or share was overvalued over time. If we go back in time, the last big crash we had was the subprime crisis, which started in the US and which infected so many stock markets around the world. And that was because there were certain practices, without going in details, which were termed as sophisticated. Some people were very clever, but at the end of the day, they were actually buying things that had no value. So effectively, you had banks which basically sold their loan portfolios into the form of sophisticated instruments, which were bought by other investors, etc. And we had what we call the subprime crisis. Because what happened is that you've got companies or banks in some other parts of the world realizing that they've bought a share or a bond, and the underlying it was probably someone whose lost his job or was unable to pay for his housing loan. But this had been going due to speculation. It had risen in value. And when the people started defaulting and the banks had to call on to buy, to realize the securities of the house, they found that if you look at what the share value was or the bond value was, you would find that maybe something worth $100,000 was actually the underlying security was worth maybe $10,000 or $20,000. This is what caused the crisis. So it's not the stock exchange as itself which was the problem. It was those speculative actions often out of greed by sophisticated financial people. When you get into theory, you get into what you call futures, etc. You don't understand what you're doing, and this is the risk. And that is actually what happened. So there are definitely risks, and there are also events like wars, which, let's say, if there's a company which is engaged in the travel industry, for instance, let's say the COVID here, the share prices of airlines have dipped. But if you look now, they're all on the rise because the world is opening. So there are extraneous events that are going to happen, which are going to impact the market. Some are going to be short-lived. Some are going to be just major corrections as the investing people or the investing public come to their senses and realize that they've just bought something which is overpriced.
So it's not the stock market's fault that there are stock market crashes. Would you agree with this?
I would tend to say that stock market or stock markets act as a sort of barometer of the economy. This is the way that the governments like to sort of portray the role of the stock market. But there was also the fact that the stock market reflects a bit the sentiments of people who invest, the investments of people, of corporates, etc. But if you take all these on a grand scale, right, on a sort of collective assessment, so it's some game, as one would tend to say. So at one point in time, and as you mentioned, so you spoke about indices. So indices is just a reflection of the totality of all those particular prices of oil, right? So summing up in a sort of figure, a numerical figure, on how the stock market is heading. But at some point in time, because it reflects the sentiments of people who have invested their money, their funds, etc. So when things go bad, and you have speculative practices also around, right, at each and every corner. So there is a time which comes sometimes when the economy goes bad or when things go bad for a certain sector, like the tourism sector, for instance, that people would tend to sell. So the selling of stocks, etc., plunges the stock market with regards to those particular stocks at a point in time. But as you said, Niazi, so very surprisingly, just after the storm, you just see those prices rise against expectations sometimes. And the hodjas have not been filled up to date now, but you would see that the prices are soaring. So it's like, it's a game, it's like a gameplay. It's like a sort of battle play where you have people coming in, putting in their money, and of course speculating. And it's this sort of sentiment that people would have to corporates, people that would like to invest their funds, their money, in order to reap the returns, of course, evaluating the risks and rewards at the same time.
Yeah. So I think we've almost reached the end of our time. So let's just summarize. Stock market is the place where the shares in companies and the debt instruments of companies can be bought and sold. So it's a marketplace. The shares take various forms. We have simple shares, which are basically parts of a company that the owners have. That's separate from, let's say, a partnership. The stock market does impose a discipline on the companies that are listing, and that gives advantages for people who want to invest. It is a shortcut and an assurance, but there are also dangers. I think we've heard it's a game, it's speculative. So in a way, my view is it's a tool, it's a way of making an investment, but it can also be misused. And I think when it goes into speculation, when it becomes a bit like Islam says, everything depends on the intention. If your intention is to invest in a company and earn parts of the profit, which is 100% halal, then you hold it to get dividend. If your intention is to buy now to sell tomorrow at a higher price, that is bordering on speculation, and another word for speculation is gambling, which we know is haram. We hope that we've covered a complex topic. We may have to have another program to go into a bit more of some of the more in-depth details. But thank you very much. I hope we've shed some light on the complex world of shares and stock market. Thank you for your attention, and I hope to see you in the next program, Focus on Finance. Assalamu alaikum.